Hey guys, welcome to another Trade Genius podcast. Bob and Phil here, as always. Guys, it's coming. Big storm, going to hit the markets next couple of weeks. We got a lot to talk about. Let's dive in.
Trade Genius.
All right, Bob. So here we are, just cruising through the month of November. Seasonally a bullish month, hasn't disappointed. Everything looks rosy, but the data tells us that things are about to change.
Yeah, we said Halloween would be scary, Thanksgiving would be enjoyable. And now, people keep talking about the Santa rally. People don't realize Santa doesn't come till after Christmas. He's actually Russian, and he does Russian Christmas. Okay. So next week is a kind of a bunch of headwinds are hitting us. We have 140 billion fill in bills and notes, which means that's money that has to come out of speculation to pay for it. Number two is that we're coming off a short low volume week with people on vacation. We have the CTAs now that went from being extremely short to be moderately long. And then we have tax loss selling before the first of the month so that people don't get hit with the wash sale rule. So we have a lot of things against us here for the next week or two that should give the market at least some pause. Do you agree with that?
Yeah, and it's not just the traditional markets too. Bitcoin does not fare well after Thanksgiving. In the last 3 years, we've had significant sell-offs, sometimes double-digit percentage sell-offs. And, Bitcoin's been on a rise here for a number of weeks now. Could easily give us another rotation. In fact, in this move up from the lows, we've seen multiple 20+% pullbacks, and we're ripe for that again. So given the seasonality, it can also definitely find its way into crypto, Bitcoin pulling back, and I think it's a good probability for that this year.
Yeah, the other thing too is the 10-day look ahead averages all for next week are red. So typically it's very hard to have red days when you look at an average in the stock market, at least the index. But next week has a few of those in there baked in, so it's a natural a dip here in terms of performance over the next 2 weeks. And because VIX has been low now, we're getting less of a Vanna hit, than we would. What Vanna means is that, money that's available for them to continue to lower volatility. They're going to have to take this thing down lower than it's been. And I think they will going into January. I wouldn't be shocked to see VIX at under 10 for the blow off in January, Phil. But for now, you're not going to really get it. And, the charm, which is basically the theta decay, really kicks in the next 2 weeks after these 2 weeks coming. So I think there's a repositioning coming. And so we're not trying to be dramatic here, but we're saying there's going to be a pullback, and there's a lot of stocks that are just way overdone here. And so it's going to be really interesting to see. But I found a chart that's pretty interesting, Phil, because people always ask us when the bear market, and we're always looking for correlations to kind of help us understand when we think this next big sell-off is going to come. And by the way, we're the March to July crew here with all the correlations lining up. Jam Croissant is end of January. We should see a top. But I think the big selling is going to come in the spring, going into summer. And if you want to throw this chart up, Phil, this kind of maybe supports that a little bit. You have the T-bill issuances here. This is the discounted T-bills. I think this is the 90-day. And so typically bear markets occur when the moving average starts to roll over. And if you notice in 2000, we had a pretty sharp correction in the yields and bills. And we got to 2008. This is what we're kind of feeling now. 2000, 2007, and 2008, anybody who was short the market up until July of 2008 were basically getting laughed at like people are laughing at them now. But when you get a stall like that in the bills and it rolls over, then it's pretty dramatic. And we're now peaking at that level again, Phil, and it's been sharp. So it's going to be really interesting to see what happens. I know that there's a war going on between Yellen and Powell. Hey guys, we got Black Friday specials. They're really cool. We have the best pricing for the year. You can get our basic package, our advanced packages, our VIP rooms, software, trade options, trade crypto, trade the futures. With us, get our indicators, best prices of the year. Take advantage of it. Thanks for listening. and maybe they're in collusion and it's a fake war. But, for him to be able to get that higher yield on the long end, he's going to either have to buy the T-bills on the low end and force people higher into the curve, or he's going to have to keep raising the Fed funds rate until he blows up the market that way. So I think those are two options on that. Do you have any thoughts on this chart?
Yeah, they can only do so much T-bill issuance, right? Because at some point, because otherwise, you look back on the chart and go, well, why did it taper off and then fall back? Well, it's because they can only sustain a T-bill issuance at a certain clip. And at some point, they cannot fund that anymore because you're rolling over that debt that you're issuing over and over and over, and it's only 90 days. So you have a cash flow problem there. And as everyone knows, this country is deeply in the red. So typically they only allow about 23% of any given debt issuance is T-bills. They're actually exceeding that this quarter by quite a bit. So call it the last hurrah or whatever you want. They cannot sustain this. So I suspect we're going to see this flattening like we saw in March of 07 and around that March 01 timeframe. I think we'll see a flattening in the issuance. And then of course, as that rolls over and you cross over that average from the top side down, then you get into recession. And it's funny how the timing works. And if you notice the last couple of times, presidential election years didn't matter. They rolled over right into it. Because really what matters is managing the debt. More than anything else, managing the debt and keeping the bond market stable. Everything else is secondary. And sometimes that works out in election cycles and sometimes it doesn't. And given what happened with COVID and the debt and quantitative tapering, it is what it is. So they're just going to have to deal with it going into this election cycle. So don't fall for it can't happen in an election year, because it certainly can happen and it has happened in election years and it's not pretty. So it really depends on, I think, the debt cycles. So Bob, with this chart here, I think it's telling you that we've crested and now we have to brace for what's coming, and what's really coming. And I think we're going to segue into that now is the debt issuance that's upon us.
Yeah. And, and you make a good point. There's only so much money left in the Ponzi pot, right? Before even the T-bills will start sucking oxygen out of the room, because once that RRP is empty, if the Fed doesn't buy, Yellen's screwed. And if she keeps layering and making pyramids on this, she ends up putting herself into a pickle here. And especially if the economy continues to slow, there's going to be less tax receipts, et cetera, et cetera, et cetera. So, this is what we want to talk about today, guys. Next week will be really interesting. We're not doing a podcast tomorrow. We'll do on Friday, Saturday. And next week if you're a dip buyer, you want to pray that we're right so that you can get in front of the last hurrah here. Basically, December 15th to January 15th would be my window of the final buy here before you better start thinking about cash as a position.
Yeah. And, we got 170 billion in debt that's being issued on bonds. So not T-bills, but bonds. There's a big difference. And when the bond issuance comes, then, that's typically when the wind gets taken out of the sails of the market. And if you guys recall back in October, I don't have the chart up, but back in October, we topped out right before they issued a whole bunch of longer term debt issuance in notes and coupons, the bonds, not the bills, but the bonds. And that killed the market. And we dropped from just under 4,400 all the way back down to about 4,100 or so. And we're running into the same situation here. That's why we're saying the next couple of weeks, it's probably not going to be bullish. There's a ton of debt that needs to be absorbed by the markets. So they're going to be using the equity that normally they can roll over into the stock market. Now that's going to be used to take up some of this debt, because that money has to go somewhere. And that's the easy money right now, is that debt coming, because you're getting, high 4s, 5%, for nothing, basically, to park your money. And the price of the bonds themselves, the face value is depressed from what it historically has been. So there's a lot of pluses to taking that issuance as it comes out. So I think we're going to run into a similar situation that we had at the middle of October. And then I think that's going to be your one and only chance to get a pullback here. And then you're going to get that late December rally into the new year. And then buckle up, because Janet deferred the recession, but she didn't stop it from happening, and it's coming.
Totally agree, guys. Hey, look, have a great Thanksgiving. See you on the other side. Hit like, hit the notification bell, tell your friends. And if you want to trade with us, Friday, Saturday is your last day to get the deal. And people are loving the worm. So get that Trade Force indicator. It'll change your life. Have a good one, Phil.
Take care, guys.
Trade Genius.